Ever wondered why some people become millionaires in the stock market while others lose everything? Welcome to the world of stocks, a place that can turn paupers into princes and princes into paupers. The stock market is a fascinating landscape, teeming with opportunities for wealth creation, yet fraught with the risk of loss. It's not a roulette wheel or a slot machine where luck is the only factor at play. Instead, it's a complex system with its own set of rules, structures, and principles. Think of the stock market as a grand marketplace, not unlike a busy bazaar or a bustling farmer's market. Instead of fruits, vegetables, and trinkets, however, this market deals in shares of public companies. Every day, millions of these shares change hands, bought and sold by people hoping to make a profit or avoid a loss. Yet, unlike a traditional market where prices are relatively stable and predictable, the stock market is constantly in flux. Prices rise and fall with every passing second, influenced by a multitude of factors, ranging from global economic trends to the latest news about individual companies. And here's the fascinating part. These price movements aren't random. They reflect the collective wisdom of all market participants, each of whom is trying to predict how a company's future earnings will compare to its current price. When more people believe a company will do well, they buy its stock, pushing the price up. When they believe it will do poorly, they sell, pushing the price down. So, how do some people manage to make millions while others lose their shirts? It all comes down to understanding. Those who take the time to learn about the stock market, to study its rules and structures, to analyze the companies they invest in, and to make informed decisions based on that knowledge, tend to do well over time. Those who treat the stock market as a casino, betting on stocks without understanding them, often end up losing. By understanding the stock market, one can make more informed decisions about investing. So, buckle up and let's embark on this journey of understanding together. The stock market may seem like a modern mystery, but with a little patience and perseverance, it can be decoded. So, what exactly is a stock? Well, in the simplest terms, a stock is a slice of a company. When you buy a stock, you're essentially buying a piece of that company. You're becoming a part owner or a shareholder. The more shares you own, the larger your slice of the company becomes. But why would anyone want to own a piece of a company? The answer lies in the company's potential for future earnings. As a shareholder, you have a claim on a portion of what the company earns. This could be in the form of dividends, which are regular payouts of the company's profits, or it could be in the form of the stock's value increasing over time as the company grows and becomes more profitable. Now, let's talk about how the price of a stock is determined. This is where the concept of supply and demand comes into play. If a company is doing well and more people want to buy its stock, the price of the stock goes up. This is because the supply of the stock is limited. There are only so many shares a company can issue. On the other hand, if a company is not doing so well and people want to sell its stock, the price goes down. This is because the supply of the stock is greater than the demand. This dance between supply and demand is a continuous process that takes place in the stock market every day. It's what makes the stock prices fluctuate, and it's what makes investing in stocks both exciting and risky. So, to wrap it up, a stock is not just a piece of paper or a digital entry in your online brokerage account. It's a share in the ownership of a company. It's a claim on a portion of the company's future earnings, and the price you pay for it is determined by the balance of supply and demand. In essence, buying a stock means buying a piece of a company's future. Now that we know what a stock is, how does one go about buying or selling it? You might picture a bustling trading floor with shouting brokers, but in reality, most stock trading today happens electronically. At the heart of this process are stock exchanges, such as the New York Stock Exchange or the NASDAQ. These are marketplaces where buyers and sellers meet to trade stocks. But you, as an individual investor, don't walk into these exchanges to make your trades. Instead, you employ the services of a middleman known as a broker. These brokers can be individuals or companies that have the right to trade stocks on the exchanges. They take your order to buy or sell a stock and execute it on your behalf. So how does this process work? Let's say you want to buy 100 shares of a particular company. You place your order through your broker, who then searches for a seller offering the best price. Once a match is found, the transaction is completed, and the shares of the company are now in your name. But what determines this best price? Stock prices aren't static. They fluctuate throughout the day. This movement is based on supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. These fluctuations can be influenced by a myriad of factors, including the company's financial health, economic news, and market sentiment. It's a dynamic process that requires constant monitoring and a good understanding of the market. It's also worth noting that while this trading process may seem straightforward, it's not without risks. Stocks are volatile and can fluctuate significantly in a short period. It's crucial to have a solid investment strategy and the right tools to navigate the stock market successfully. Trading stocks is a complex process, but with the right knowledge and tools, it can be navigated successfully. How do individuals earn from the stock market? A question that has intrigued many. There are two main routes to reap profits: through appreciation in value and through corporate distributions. Let's delve into the first method. Visualize purchasing a piece of a company. As the firm grows and becomes more lucrative, the worth of your share follows suit. If you sell your share for more than its purchase price, you earn a profit. In simpler terms, the strategy is to buy when prices are low and sell when they are high. Moving on to corporate distributions. Mature companies usually share of their earnings with their investors. These payouts are a token of appreciation from the enterprise for your faith in them. If you are a holder of such shares, you'll be entitled to a specific sum for each share, typically on a quarterly basis. Earning from the stock market not only involves these two methods, but also requires astute decisions about when to purchase and when to sell. This is where market understanding comes into play. Monitoring market trends, business performance, and economic indicators are essential. It's important to bear in mind that investing in stocks is not a path to quick riches. It demands patience, strategic planning, and resilience. Also remember, just as you can earn, you can also incur losses. Share prices can tumble, and not every company distributes profits. Hence, diversifying your portfolio across different stocks is generally advisable. Earning from the stock market is a fusion of comprehensive market knowledge and intelligent investment choices. It's much more than mere buying and selling. It involves informed decisions backed by diligent study and careful strategy. Investing in the stock market isn't without risk, but it also comes with potential rewards. This is a truth universally acknowledged in the world of finance. But what does that mean exactly? Let's dive in. Firstly, the risks. The stock market is not a guaranteed path to wealth. In fact, it's entirely possible that you could lose your entire investment. This can occur when the company you've invested in performs poorly, or in worst-case scenarios, goes bankrupt. The value of stocks is influenced by a myriad of factors, from company performance to global economic conditions, and predicting these can be akin to predicting the weather. In addition, the stock market can be volatile, with prices fluctuating rapidly in very short periods. This volatility can lead to significant losses if investments are sold during a market downturn. Therefore, it's crucial to understand that investing in the stock market is not a get-rich-quick scheme, but a long-term strategy that requires patience and resilience. Now, let's talk about the rewards. The potential for significant financial gains is what attracts many people to the stock market. When a company performs well, its stock price typically rises, leading to capital gains for its shareholders. Additionally, some companies distribute a portion of their profits back to shareholders in the form of dividends, providing a steady stream of income. The beauty of the stock market is that it provides opportunities for wealth creation that are accessible to everyone, not just the financial elite. But remember, the greater the potential reward, the greater the inherent risk. So how do you navigate these risks and rewards? It all comes down to research and understanding your tolerance for risk. Knowledge is your greatest weapon in the stock market. Get to know the companies you're investing in, understand the market conditions, and most importantly, understand your financial goals and how much risk you're willing to take to achieve them. Understanding the risks and rewards of the stock market can help potential investors make informed decisions. So equip yourself with knowledge, understand your risk tolerance, and enter the stock market with eyes wide open. So, what have we learned about the stock market today? We've unraveled the modern mystery of stocks, discovering that they represent a piece of ownership in a company. We've delved into the mechanics of stock trading and gained an understanding of the risks and rewards involved. Remember, while potential for gains exists, losses are also a part of the journey. Knowing how the stock market operates is the first step towards successful investing. The next move is up to you.